Okay, hello everyone. We're just waiting for the attendees number to grow a little. We're currently up on 60, expecting about 200, which is a really good number for today. So we'll just give another 60 seconds or so for everyone to join. Okay, so the number is stabilizing now about 90, so we'll kick off at this stage. So good afternoon, everyone. For those who don't know me, I'm Declan Lavelle and I'm the current president of the Society. So you're all very welcome to this afternoon's webinar, which I know you're eagerly looking forward to. I believe we will have up to 200 attendees and we're approaching 100 at the moment, which is a fantastic turnout. We have a very wide range of topics to present this evening, so I'm certain there should be something for everyone in the audience. You'll see on screen the usual disclaimer that the opinions are the opinions of the speakers rather than the Society. I'd also draw your attention to the competency wheel where we've marked out the particular competencies that we think this afternoon's session is hitting. In terms of CPD, just to note that once you've registered with your full name, the Society will have a record of your attendance. And while there's no longer a need for verifiable CPD in the Society scheme, we appreciate that there may be other organisations that require verification. So the Society will have that record for you. The webinar is being recorded, and so is the Q&A segment, and we plan to upload both to ActuView and YouTube after this webinar is over. All attendees are automatically muted, and because of the large number of speakers and topics, we're not encouraging the raise hand feature this evening. Instead, questions can be submitted at any point through the Q&A portal, which you should see at the bottom of your screen. Questions can be posted either alongside your name or anonymously if you prefer. So, moving on to the first item on the agenda. The current topics paper is an initiative of the recent Qualifiers Committee, and this paper has been produced roughly every 2 years since 2001 by a group of recently qualified actuaries. The paper is an ideal one-stop shop for anyone wanting an update on recent developments and market issues. And as well as the presentations this evening, I should mention that the accompanying paper will be available shortly online after the webinar. So in a moment, we will have a series of presentations across a wide range of areas: life and health insurance, pensions, general insurance, climate change, and diversity and inclusion. Afterwards, we'll have a Q&A session to pick up on questions submitted during the presentations. And then finally, after that, I'll hand over to Dara Pelly to announce the winners of the Creative Use of Actuarial Skills competition. So without further ado, it's time to hand you over to Jack McHale, who will present the first of the current topics, IFRS 17.
Thanks, Declan, for that introduction. Just share my screen here. Okay. So first up under current topics, we have everyone's favorite hot topic, IFRS 17, which I'll take us through before handing over to Cormac, who will discuss the Solvency II 2020 review. As a bit of background about myself, my name is Jack McHale, and I've been working as a consultant in Willis Towers Watson's insurance consulting and technology practice here in Dublin since 2018. The IFRS 17 section in the paper is about 6 or 7 pages long, and I've included a couple of slides here to give an idea of what it covers. And I should say it's written from a life insurance point of view. So rather than going over the basic components of IFRS 17, which I think we can take as assumed knowledge at this stage, we wanted to take a high-level look at what the implications of the move will be from, say, a shareholder or CFO's perspective once everything's up and running. So with that aim in mind, the paper contains, firstly, an overview of changes to life insurers' reserving bases from IFRS 4, as it's interpreted in Ireland, to IFRS 17. Then, as a result of these changes, potential impacts on reported earnings with some possible implications for dividends also, and a quick look at KPIs too. So first up, we have a comparison of an example life insurer's IFRS 4 basis versus IFRS 17. Now, as a quick disclaimer, the IFRS 4 bullet points here are based on my own experience as a consultant working with life companies in Ireland. But it's important to note that there are differences in the interpretation of IFRS 4 across companies in the market here. And for those of you who work in this area, your own IFRS 4 basis might look different to the slide here in some respects, but hopefully the points here look broadly familiar. So how will things differ under the new regime? I'll just run through the bullets quickly. IFRS 4 cash flow assumptions may include some degree of prudence, whereas IFRS 17 cash flows must be best estimate. Now, on the other hand, IFRS 17 includes a separate risk margin element, the risk adjustment, whereas under IFRS 4, there's no requirement to hold such a margin. So what happens when a new contract is written? Keeping things as simple as possible. Under IFRS 4, if the expected outgo on a policy, allowing for whatever prudence margins are in place, is less than the expected income, the difference can be booked up front as a profit in that year's P&L. That's before considering things like deferred acquisition costs. Under IFRS 17, profits can't be recognized up front in this way. Instead, a CSM liability will be set up at policy inception, which will be based on the expected future earnings on the contract, and that's then amortized over the contract lifetime. And as that liability runs off, this is recognized as income in the P&L. So how do profits emerge over time? Under IFRS 17, as I've just laid out there, the CSM will be amortized as the business runs off, as will the risk adjustment. Under IFRS 4, subsequent to the once-off profit or loss at the beginning of the contract, the prudence margins in the reserves will be released as the business runs off, assuming everything goes as expected, and then that'll be recognized as income. One more point to touch on in this slide is the impacts of changes to assumptions. So under IFRS 4, any changes in reserves due to changes in assumptions will flow through to the P&L for that year. So there's a once-off impact of making that change in assumptions in the income statement. Whereas under IFRS 17, any changes in assumptions will flow through to the CSM instead, either increasing or decreasing it, depending on whether the basis is being strengthened or weakened. So in this way, the impact will be spread over the remaining lifetime of the contract, rather than all coming through the income statement in the year that the assumption change is made. Then moving on to transition and some ideas to consider here. What do I mean by transition? A CSM will need to be established for each cohort of business, which is in force on the transition date on the 1st of January next year. There are several different approaches laid out in the standard to do this, which I won't go into detail on today. But depending on which transition approach you adopt, you may end up with a different amount of CSM for the same group of contracts. The higher the CSM, the less once-off profits that will come through on transition, but the higher subsequent profits that will be recognized each year as the business runs off. And this effect is illustrated at a high level in the graph here. And this raises an interesting point, which is, would you rather have a higher or lower CSM for a given book of business on transition? Just as one example trade-off to consider, if you have a higher CSM, once-off assumption changes should have a relatively smaller impact on the P&L for the year that the assumption change is made. Now, one disclaimer to state here before I move on is that depending on a company's specific situation, for example, with respect to how much data they have available, there may not be that much choice about which transition approach to adopt for a given group of contracts. Now, if I circle back for a second to the differences in basis between IFRS 4 and IFRS 17, these changes in basis will change the timing of when profits are recognized over the lifetime of a contract. And those changes in timing have implications for the bottom line earnings which are reported in the financial statements, and hence possibly for the dividends that can be generated. This was explored in the IFRS 17 working groups deep dive into presentation and disclosure last year. So I won't spend too long on it here, and I do recommend watching the recording of that session if you're interested in digging into this more. But at a high level, changes in reported earnings due to the move to IFRS 17 may affect dividend paying capacity, but there are other constraints on companies' ability to pay dividends also, such as regulatory capital requirements, which in Ireland is Solvency II, and cash generation. And all of these constraints will vary in relative importance depending on a company's specific situation. So will the change to IFRS 17 affect the amount of dividends a company will pay out? The short answer is, it depends. But rather than just saying it depends, we can dig into this a bit more by looking at specific examples of what companies are saying. We don't have a lot of investor communications from companies on this topic yet, but I've taken one such publication from a bancassurance based in the UK and summarized the highlights here. So their view is that the cash flows and the capital generation from their insurance business are unchanged, and hence the economic value of the business is unchanged. Also, for them, the reported earnings under IFRS 17 are expected to align more closely to the underlying cash flows compared to their current IFRS 4 basis. Now, that may not be the case for all companies. And crucially, no impact on dividend paying capacity is expected, as Solvency II capital requirements are expected to continue to be the binding constraint there. So perhaps it's not the most exciting example, considering the end result is no change expected to dividends, but it's still good to have a real life data point. Now, where it could get more interesting for companies is where dividends are, for whatever reason, managed primarily against IFRS earnings, rather than regulatory capital requirements in the first place. The paper also touches on key performance indicators, KPIs. And again, this was explored in the working groups session last year, so I won't spend too long on it here. What is interesting is that some rating agencies have issued their own publications on KPIs with respect to IFRS 17. So for example, what information they expect to be provided alongside the IFRS 17 financial statements in future. And the paper touches on this. So just to briefly recap this section of the paper, the implications of the move to IFRS 17 on insurers' financial statements and hence on their reported earnings and their dividends, it will vary between companies. It will depend on a number of factors, including their specific business, their current interpretation of IFRS 4, and the methodology choices they make in implementing IFRS 17. There's been limited information published so far by insurers on how their financial statements and reported earnings will change under IFRS 17. Probably less than I was hoping for when I volunteered for this section of the paper at the start of the year, but we are expecting to see more communications to investors on this topic in the coming months. So watch this space. And with that, I'll hand over to Cormac for the Solvency II 2020 review. Thanks, everyone.
Thank you very much, Jack. I'll quickly, once you've finished up there, I'll share my screen and jump into our next section on regulatory updates and the Solvency II 2020 review, as well as some other sort of more timely regulatory updates that we wanted to consider. So first of all, a quick introduction. I'm Cormac and I'm a consultant with Mellman. So for the next few minutes, we're running through recent regulatory updates on Solvency II 2020 review and the recently published amendments on the EIOPA guidelines on the valuation of technical provisions, and then the guidelines on contract boundaries as well. So while my own background is primarily in life insurance, both of these topics are really relevant across the board. And so in our paper and then in this presentation as well, we'll very much be considering them from a broader perspective rather than just life. So the Solvency II 2020 review is really something that I know a lot of the audience here today will be very familiar with, given how long it's been going on for. However, given the length of time which has passed, I appreciate that others may be less familiar with it, depending on their own backgrounds and what they're working in and exposed to. So I'll try and strike a balance really for everyone, but please do use the Q&A functionality if you do have any questions or if you wish to ask about sort of specific topics that I mightn't get to today. So the review of the Solvency II directive has long been signposted, really. The directive itself states that the European Commission should conduct a review of a number of items, such as transitional measures and the SCR standard formula, for example, by the 1st of January 2021. And so in February 2019, EIOPA received a call for advice from the European Commission. And this process included a public consultation, an information request then to assess the impact of the proposals would have on the industry, followed by a second information request to assess the impact post-COVID-19 and what they'd look like sort of in that context. And then finally, in December 2020, EIOPA published its opinion on the Solvency II 2020 review for the European Commission to consider. So in September 2021, informed by this advice, the European Commission adopted its review of the Solvency II directive. Recently, these proposals have moved on to the next stage of the review and are currently being discussed at the European parliamentary level, sort of the final stage of it. So at this stage, the Solvency II 2020 review has spanned multiple current topic papers, and it's very likely that'll probably still be included in the next iteration. The EIOPA has already stated that the sort of implementation of any of these changes are likely to be closer to 2025 than 2020. So for this paper, we decided to focus on the proposals that were finalized by the European Commission in 2021, the sort of most recent information that we had at the time of writing. And you can feel that the remainder of the session really going through each of these proposals and changes and amendments. And I've tried to capture sort of some of the key high-level areas that have been considered in the review on this side here. Now, I won't discuss them all today, but I will run through sort of a selection of the ones expected to impact the Irish market. So from a Pillar 1 perspective, an alternative interest rate extrapolation methodology has been proposed. Now, this intends to utilize more market data, but the final parameters of this are still yet to be calibrated, and so the ultimate impact is still not quite known. This is only really likely to impact businesses with very long duration, sort of plus 20, 30 years. And a phased approach has been proposed by the Commission to sort of allow for a grading in of this, but it's unclear whether that grading in approach will ultimately be brought in the final changes brought in by the European Parliament. Regarding then the volatility adjustment, there was a host of different changes were proposed by the Commission and by EIOPA in its advice. So that there are real challenges really in assessing the actual impact of these proposed changes at an industry-wide level, as it's very much dependent on prevailing market conditions and volatility, unsurprisingly, given the name, at the time that the assessment actually takes place. There's also an impact will very much vary from company to company, depending on your own asset makeup and liability makeup. It is still proposed that the use of the volatility adjustment will continue to be subject to supervisory approval. Regarding then the risk margin, the Commission will consider building upon the lambda approach, which I appreciate won't mean a huge amount to some people in the audience, and other people will be sick to the teeth of it. But the idea behind this really is to dampen the cost of providing capital in future time periods with a higher impact sort of in further out you go. All things being equal, this will generally lead to a reduction in the risk margin and a release of capital. The most material proposed changes regarding the SCR then are in relation to interest rate risk, which proposes a relative shift approach to the shocks rather than the current approach that we see. So with the relative shift, as the name implies, this will very much lead to the stress applying even in negative interest rates, unlike our current approach at the moment. Again, the calibration is yet to be finalized, so it's unclear quite what that impact will look like at a European-wide or sort of national level. EIOPA has also proposed a number of other changes to the standard formula, which will be implemented through changes to the delegated regulations rather than to the directive itself. Then in the context of Pillar 2, and I suppose particularly the ORSA, the proposals state that companies must assess the impact of macroprudential risks on their business and risk profile. Now, the proposed changes to the directive specify that this assessment shall include, for example, among others, interest rates, spreads, inflation, obviously particularly relevant at the moment, climate change and pandemics, just to name a few. And the paper does include a more complete list of these proposals. The European Commission has also communicated that it intends to establish a harmonized recovery and resolution framework across the EU. However, it's not expected, currently anyway, that the current CBI regulations in this area will be substantially changed in light of the proposals from the Commission and whatever finalized form that they ultimately take. I'm conscious of time, but one last piece that I did want to highlight before moving on is that the European-wide insurance guarantee scheme, which was proposed by EIOPA in its initial advice, was not included in the European Commission's recommendations. It's unclear whether this topic will be picked up again as proposals are discussed and finalised at the European Parliament. But I suppose one thing to note, it's always interesting when something gets dropped off a list like that. And I suppose for those interested in some further reading, I did see today that the Actuarial Association of Europe has just released a report detailing its position on the Solvency II 2020 review. So a little bit of homework for anyone who's interested in some further reading. There was one other regulatory update which we did want to include in the paper, given its timeliness. So in April 2022, EIOPA published its finalised report on the revision of the guidelines on contract boundaries and the guidelines on the valuation of technical provisions. And the consultation period for this review took place between July and November last year, and the revised guidelines will apply from the 1st of January 2023. So there were a reasonably large number of amendments brought in, and unfortunately with time pressures, I don't really have time to go through each one, but they are covered in more detail in the paper. At a high level, EIOPA targeted the following divergent areas of practice in relation to the calculation of technical provisions. These were the proportionality principle, assumption setting considerations, investment management expenses, and the apportionment of expenses, financial guarantees and contractual options, future management actions, and the role of the actuarial function on the calculation of expected profit in future premium. And then the paper goes into much more detail, but one particular amendment that we wanted to highlight was around investment management expenses. In its consultation paper, EIOPA proposed prescribing that the investments backing the technical provisions and the SCR were to be included within the scope of the investment management expenses in the BEL, in the best estimate liability. However, the final report differs on this point, stating that insurance and reinsurance undertakings should include in the best estimate administrative and trading expenses associated with the investments needed to service insurance and reinsurance contracts. Now, EIOPA does give specific examples of this for unit-linked business and ring-fence funds, but there is still some uncertainty as to how this principle really applies for other types of contracts, particularly where there isn't a ready-made pool of assets as a reference point. Lastly, then, on contract boundaries, EIOPA has provided clarity regarding a number of considerations for setting contract boundaries, and it has also provided a number of examples in relation to contract unbundling. In its report, EIOPA has stated that these revised guidelines shouldn't automatically lead to a reassessment of contract boundaries of all existing business. However, if companies are using practices that clearly deviate from the new guidelines, then they've stated that they should perform a reassessment when these guidelines are applicable. So certainly worth checking out that paper and reading through the report to confirm your own approach and the alignment there. So with that, very much a whistle-stop tour of that section of the paper. I'd like to thank you very much for your time, and I'll now pass on to Leslie, who'll be discussing health insurance market developments. Thank you very much.
Thanks, Cormac. Hi there, my name is Leslie Carew, and I currently work with Canada Life Reinsurance and have been working as an actuary, primarily in life insurance and consulting for the last 7 years. As part of my time in consulting, I was involved in client work in the area of healthcare, and I am also a member of the Society's Healthcare Committee. So today I'm here to talk a little bit about the healthcare sector, and in particular, the private health insurance market in Ireland. Yeah, if you can click there, thanks. Yeah, so private health insurance is the largest non-life insurance market in Ireland, and it continues to grow. The insured population has increased from 46% in December 2019 to 47.1% as at December 2021. There are three main insurers in the market: VHI Healthcare, Leia Healthcare, and Irish Life Health. I'm sure you all know there's a very large product offering of 317 plans, and this consists of a mixture of lower cost cash plans or outpatient plans and higher cost plans which might cover high-tech hospitals, semi-private care and private care. However, only 10% of the insured population have lower cost plans, so the other 90% are in these higher cost plans. So according to the HIA, the average premium as at 31st of December 2021 was a staggering €1,470. So within the market, a community rating operates, and this means that all consumers should be charged the same premium for the same product, regardless of their risk profile. Lifetime cover also operates, and this means that once you join and pay premiums, insurers cannot refuse to provide you with cover. And open enrollment also operates, and this means that the PHI companies must accept anyone who wishes to join. The market is regulated by the HIA, and a risk equalisation scheme, or RES, is in place to support the community rated market. Risk equalisation means a premium levy or contribution based on the perceived riskiness of insurers' portfolio for all the insurers is collected into a fund. This helps spread some of the cost of the higher claims from higher risk lives across all insurers in the market. Next slide, please. So I guess the best way to show how the RES actually works is by a diagram. So the Health Insurance Authority sets stamp duties and levies, age credits, the hospital utilisation credits, and more recently, what has just been added is the high cost claims pool credits. I'll get to these later. The stamp duties are charged to policyholders as part of their premium, and these are then passed by insurers to the revenue. Risk equalisation credits and stamp duties are calculated using estimates of the expected market position over the period they will apply. However, payments to and from the Risk Equalisation Fund are based on actual underlying business mix and hospitalisation experience of the different insurers. So insurers with a higher than average risk profile are net recipients of the fund, and insurers with a lower than average risk profile are net contributors to the fund. It is also important to note that the scheme is a zero-sum game, in that the aim of the Risk Equalisation Fund is to pay out as much as it takes in, so there's no surplus or loss made. Age-related healthcare credits vary by age, gender, and level of cover, and they're given to ages above 65. So it's a prospective measure based on the characteristics of an insurer's policyholders. They are paid out on day one of the period. Hospital utilisation credits are payable in respect of some health services and some daycare services. This is a retrospective measure based on actual day and hospital night stays in a hospital setting. These are paid as claims come in from insurers. In order to make the risk equalisation scheme more effective at its aims, a high-cost claims pool has been introduced into the scheme. High-cost claims pool credits are also paid as claims come in from insurers. Next slide, please, Cormac. Thanks. The RES was first granted the EU Commission approval in 2003, and a number of further RES approvals have occurred since then. The RES was most recently approved to be extended by the European Commission for a further 5 years in 2022. This included the approval of the proposal to include a high-cost claims pool. It has been proposed that the high-cost claims pool will be initially set at a 40% quota share and €50,000 threshold. So you might be asking yourself, what's that actually mean? So it means that insurers will be paid credits equal to 40% of the cost of claims that are in excess of 50,000 in respect of a specified period of cover. So the aim of treating these high cost claims separately is to more effectively subsidise the private health insurers by smoothing the impact of the high cost claims. So this is actually a significant change, and it's really uncertain how it will impact the shape of the health insurance market going forward. So another area then, which has been updated, is the overcompensation assessment. As noted in the EU Commission's decision on the RES 2022, the overcompensation test aims at verifying whether the return on sales of the net beneficiary or beneficiaries of the RES does not exceed a certain percentage. The Health Insurance Authority is required to carry out this overcompensation assessment to determine whether a net beneficiary has made a profit in excess of a reasonable profit as required by the Health Insurance Act. The overcompensation assessment is made up of 3 steps. So step 1, you determine the net beneficiary or net beneficiaries of the RES. Step 2, determine a reasonable profit. And step 3 is the overcompensation assessment itself. So a previous benchmark of 4.4% return on sales was increased to 6% return on sales based on the recommendation put forward to the EU Commission. And this is included in an amendment to the Health Insurance Act. The benchmark will first be increased to 4.9% for the period 1st of January 2020 to the end of 2022, and then it's increased to 5.5% until 2023, and then it'll be set to 6% from then on. So next slide, please, Cormac. So I guess now on to COVID-19 and the impacts on healthcare and PHI. So I think we can all agree this has been one of the hottest topics of discussion for the PHI market and I guess the market as a whole. So looking at the impacts to date, there's been wide-scale lockdowns, rising rates of infections, including rising rates of those requiring hospitalization. There's been hospital bed shortages, and most critically in ICU, staff shortages, nationalisation of the private hospitals in Ireland in 2020. There's additional sanitary requirements and rising costs of healthcare. And these have all been major talking points over the last 2 years. The bed shortages in the public hospitals led to the nationalisation of the private hospitals in order to get some facilities for the increased demand due to the hospitalisation with COVID-19. So the private hospitals couldn't be used for that 3-month period in 2020. This, of course, then led to lower claims for the private health insurers. There was also some reluctance of the public to seek diagnosis during the period after the private hospitals began treatments again, because nobody wanted to go into hospital because they were afraid of picking up infection and whatnot. And so this led to further reductions in claims as people weren't using the hospital facilities. So as a result, insurers then offered some premium rebates to customers. So I guess we're now living with COVID and it's unclear what the medium to long term will look like, if there'll be more variants, the future vaccination take-up rates, what the winter months will hold, no one really knows. In terms of suppressed demand and waiting lists, these are still an issue and the HSE hasn't issued any guidance yet on it, on when they will believe they will return to normal levels. Now the NHS in the UK have indicated that they believe levels in their system would return to kind of normal by 2025, but there's lots of uncertainty around those estimates and it makes lots of assumptions. So I guess no one really knows. I guess reluctance to seek diagnosis may potentially lead to health issues being undiagnosed for longer periods, and as a result, they could become a lot worse than if they were diagnosed early. That might lead to higher claims, but again, it's very uncertain. So another issue seen across the whole industry is how or if COVID-19 data can even be used. So this is particularly an issue for the Health Insurance Authority as they use past data to set their stamp duties for the following year. And as such, you can't use that data as it's not representative of a normal year. So I guess that was a really, really quick tour through healthcare, and there's further information on those sections in the paper. So since the previous topic, current topics paper, the PHI market has gone through a lot of change, and it'll be interesting to see what the future holds. So now over to Tom, who's going to cover the topic of pensions. Thanks, everyone.
Thanks, Leslie. Sorry, 1 second here. Okay, thanks very much, Leslie. My name is Tom Moran, and I'll be delivering the pensions and investment section. I'm working WTW myself. I've been working there for close to 8 years now, and I work in advising trustees of defined benefit schemes and also sponsors of those schemes as well. So essentially, as I said, I'll be delivering the pension section. The paper I did, it covers the period over the last 2 years since the last current topics paper, and it attempts to summarize the main developments in the pensions landscape over that period. Okay, so the first section is a market update, and it sets out some important key developments in the market, and as well as an update on funding for DB schemes. So it starts off with some general market statistics. These figures cover the period to the year end 2021. So you can see the number of DB schemes has fallen over that period from 566 to 553, and there's total assets of circa 70 billion invested in respect of those schemes. Okay, so the number of active members for DB schemes has actually increased over that period by over 3,000 as well. So we're still seeing plenty of new active members joining DB schemes. In terms of DC schemes, we've seen an increase from 82,000 to 86,000. Okay, so that's quite a large figure there. It's mostly comprised of one-member arrangements, things like small self-administered pension schemes. You can see it's quite an increase of 4,000 from last year there as well. So one of the key developments in the pensions landscape since the last paper is the transposition of the IORP2 directive into Irish law. So this took place in April 2021. And so I suppose at a high level, the IORP2 directive, it's a piece of EU legislation, and it attempts to improve and enhance the governance arrangements for pension schemes. It also wants to harmonize governance arrangements across the EU so that common standards are in place. Okay, so this has been in the pipeline for some time. It was due to be implemented in 2019. There was some delays, and it was then implemented last year. A code of practice was issued by the Pensions Authority then in November, and that set out what the Pensions Authority expects from trustees as a minimum to comply with the new regime. So it's introduced considerable governance requirements, to say the least. It's very wide-ranging. You know, there's a whole wide range of new requirements, things like a risk management function holder who's an identified individual who needs to manage risk for each scheme and needs to assess it and monitor it and report on risk to the trustees periodically. So I guess really for a DB scheme, for instance, the scheme actuary would have been looking at things like funding risk and covenant risk, and you might have had an investment consultant who would look at investment risk. But this really goes the extra mile. You need to you know, consider things like operational risk and administration risk, and the risk management consultant needs to take that all together and report on that from an overall perspective to the trustees. We also have an internal audit key function holder, and they need to carry out a further audit on the scheme each year, checking that the controls and processes in place to ensure the smooth running of the scheme, that they're being adhered to. So that's a further audit that needs to be carried out every year as well. We have further training requirements for trustees. Okay, so there's a new fitness and probity regime essentially where trustees are assessed collectively as to whether they're fit and suitable to be trustees. So essentially, one trustee needs to undertake a professional education course. So this is quite an involved course, you know, a comprehensive training course. So all these new requirements may push some schemes into hiring professional trustees, because you know the requirements are overall quite onerous, and we've seen that with some schemes already. So I guess overall, I mean, this is a positive development for Irish pension schemes. Improving the governance arrangements can only be a good thing, really. It's, you know, it should make for better run schemes and will hopefully lead to more improved outcomes for members in general. One thing to note is that there's no derogation for smaller pension schemes. So within the directive, there was a provision to exempt smaller pension schemes from, you know, being required to enact all of these requirements. That derogation wasn't put in place for Irish legislation. So essentially, all schemes need to apply this new regime in full. Okay, so the one concern about that is that smaller schemes may, the cost of it may be prohibitive for them. That, you know, the significant extra compliance costs in place now as a result of this, and it remains to be seen, you know, whether smaller schemes will be able to facilitate that. So in terms of DC schemes, well, we can expect a consolidation of the DC market to master trust arrangements. Okay, so I spoke about how there's, you know, 86,000 DC schemes there. You know, so a stated aim of the Pensions Authority has been to reduce that number. You know, a master trust is a large-scale arrangement with thousands of members and operates for many different employers. And you know, these schemes can easily achieve economies of scale and cost efficiencies and more effective governance. So, you know, you will expect to see the DC market consolidating to those regimes there. The next section of the paper focuses on investment markets and the impact it had, with a focus on DB funding. So we saw a lot of volatility really over the 2 years since the last paper. Bond yields remained at quite low levels until early this year, when they increased considerably. Some government and corporate bonds have increased by up to 2% this year alone, which is quite a dramatic, big shift. Generally, this will have a positive impact on pension schemes. We value our liabilities using bond yields, and higher discount rates will reduce our liabilities. Now, obviously, schemes who are well matched and hold bonds to match their liabilities will see their assets have reduced in a commensurate fashion as well. We've also seen inflation expectations increase considerably, and equity markets have fallen back as well. So it may not be the case that schemes funding level has improved, although it would depend on the profile of the scheme. But if you look at the second point, we've seen high inflation in 2021 and 2022. And expectations for future inflation have also increased considerably. So any scheme with index-linked benefits, this will drive up their liabilities quite considerably. I think expected inflation, depending on the term, has increased by, just since the start of this year, by about 0.7%. So that's going to drive up the liabilities there for those schemes. A few different reasons for that. We had the economy opening up following the pandemic. I mean, we're still in, I'm not going to say we're out of the pandemic yet, but we're largely open at this point. And, there's been a resurgence in the economy, and savings that were stored away are now being spent. We've also had the issues with the war in Ukraine, leading to price spikes in energy and oil as well. So those factors have all contributed to this. Volatile equity markets, the S&P 500, for instance, which would be a main US equity index, that's fallen by 20% this year. It had a very strong 2021 in fairness, but it has pulled back again this year by 20%. In terms of the impact of COVID-19, well, Ireland saw a large number of excess deaths. I think there was roughly 2,000 excess deaths, which was obviously catastrophic, really, and a tragedy. But overall, in terms of the impact on Irish DB schemes funding position collectively, it wouldn't have had a huge impact. There is uncertainty over medium to long term mortality and the impact on that. So if new variants emerge over time, what impact that would have, or people who have been exposed to long COVID, and are suffering now, what are their future prospects for life expectancy? There's still uncertainties there, and that may affect our mortality assumptions going forward. So the next section of the report dealt with government policy in relation to pensions. So I tried to summarize the main developments there in the report. We had a pensions commission was established in late 2020. Okay, so the remit here for the Pensions Commission was to examine the sustainability of the state pension arrangements. You will recall in January 2021, the aim was, or state pension age was due to increase to 67. Now that met quite a degree of political resistance, and it was shelved essentially pending a review by the Pensions Commission. Okay, so they carried out their report and they issued it in late 2021. They came up with a few recommendations. I've summarized the main ones here. An incremental increase to the state pension age. Okay, so rather than a step up increase from 66 to 67, the new one is to go from 66 to 67 phased in over a period of time. So by 2031 is the recommendation to bring in age 67, and then so that it's age 68 by a further 8 years in 2039. Flexible access to the state pension. So if someone wants to stay in employment and access the state pension at age 70 instead, that could be facilitated with a cost neutral actuarial increase. That was one of their recommendations. Alignment of retirement ages in employment contracts with the state pension age, and also increases to PRSI rates across the board. Okay, so this report is under consideration by the government, and an update will be expected in the coming weeks. The other crucial information that was released on government policy is the auto-enrollment system. So this has been in the pipeline for a number of years. There's a lot of people in this country who don't have a form of pension provision outside of the state pension and are solely reliant on the state pension. So that's a big problem. I think it's upwards of 40% of people. So this has been in the pipeline for quite a while. The final design was recently announced in 2022, and implementation is expected from January 2024. Okay, so the key features, also bear in mind that we're one of the few developed nations that doesn't have one of these systems in place. So it's good to see that this is finally coming in. But the key features are people aged 23 to 60 who are on a salary of more than 20,000 per annum. They're auto-enrolled when they start work, they're automatically enrolled. The contribution rates are phased in over the next over 10 years. So 1.5% of your after-tax pay is what it starts off at in 2024, and that works up to 6% of net income by 2034. And so that's the employee contribution rate, and it's matched by the employer. And then the state tops it up €1 for every €3. So what's notable about this is that it's a state top-up system rather than the standard pension provision system whereby you put in a contribution out of your gross income and you get tax relief on it. This contribution comes out of your net income, but then there's a top-up applied. There's an earnings limit of 80,000 per annum for the employer and state elements of the contribution there, and also there will be a central processing authority who will administrate this system. Okay, so they're going to choose the investment managers. There'll be 3 funds you can choose from: a conservative one, a medium risk, or a high risk one. And there'll also be a maximum annual management charge of 0.5% per annum. So the final bit on the government policy was the report of the Interdepartmental Pensions Reform and Taxation Group. So a bit of a mouthful there, but this was part of the roadmap for pensions reform, which was devised in 2018 by the government. So essentially, a proposal to radically reform the pensions landscape. And they asked this group to look at some key areas. Things like simplifying and harmonizing the pensions landscape in terms of the pensions products available, and also a more in-depth look at the ARF option. That's the drawdown method where someone in retirement, instead of buying a pension, they can leave their fund invested and they can draw down from it as they see fit. So this group looked at this and they published their report in late 2020, and I've summarized some of the key findings from it. They said that the AMRF, or the minimum income requirement, should be abolished. Okay, so that was where someone needed a minimum income to set up an ARF essentially, and if they didn't have that, they needed to set aside this separate fund. This was deemed to be an unnecessary layer of complexity to the process. Most people were entitled to the state pension anyway, so it was recommended this was abolished. And in actual fact, the government did abolish it as part of the Finance Act in 2021. The next recommendation was that the PRSA should operate as the sole personal pension product. Okay, so you've got a range of different pension products available, things like buyout bonds, retirement annuity contracts, and PRSAs. So they all they're all similar enough in how they operate, but there's differences. For instance, a buyout bond, you can't make contributions to it. There's a life cover option available on a retirement annuity contract, all these differences. So, it was recommended these all be brought together and that there just be one product that, that caters for all really. The next thing was to increase the lower age limit for access of benefits. So generally people can access their fund if it's a DC fund from age 50. It was recommended to increase that to age 55. And finally, it was recommended that the ARF option be replaced by a PRSA, which operates as a whole of life product. Okay, so again, simplifying the landscape there. That covered the government policy section of the paper. There was also a small section at the end on sustainable investment, but conscious of time, I'm going to leave it there and hand over to Michael for the general insurance section.
Thanks a million there, Tom. Good afternoon, everyone. Michael O'Brien here. I work with Seagrave, Daly and Lynch. So I'm in the litigation area. I'm here to talk about a few topics in general insurance, but looking at them, I suppose, from a personal injuries standpoint. So just a standard disclaimer that we've already seen that these are my own views, and just a list of things that I intend to speak about. The personal injuries guidelines, they were brought in last year. The initial PIAB reports on those guidelines, the current position regarding court valuations and the personal injuries discount rate. Looking at that in the context of inflation, but also inflation as it refers to periodic payment orders and the current position regarding those payment orders. And then finally, I will speak about the differential pricing review and the regulations following on from that. So the personal injuries guidelines, they were formulated by the Personal Injuries Guidelines Committee, voted on by the Judicial Council, and came into effect with a commencement date of the 24th April of 2021. They apply to all claims where proceedings have not commenced or where the Personal Injuries Board has not made an assessment of damages. So here we're talking about general damages, the placing of a monetary award on the pain and suffering incurred by an individual. This is undoubtedly quite a difficult task to place a monetary value on. So historically, there would have been issues, and judges in what would be regarded as cases with similar injury could have given quite different awards of damages for what would be deemed similar injuries. So one of the aims of the guidelines is to bring about greater consistency and transparency in awards. So the guidelines cover 12 categories of injury, and they replace the Book of Quantum, which contains 6 categories. So therefore, you will see that they are more comprehensive than the Book of Quantum. Overall, as a general rule of thumb, it can be said that for minor, less severe injuries, moderately severe injuries, that the levels within the guidelines for awards are lower than within the Book of Quantum. Of course, there are more categories within the guidelines, so it is not directly comparable in all scenarios. Then, on the other hand, we have the maximum amount of general damages within the guidelines has been increased to €550,000, and this will apply in the most catastrophic of injury. And there at the bottom of the slide, you'll see there have been some challenges to the guidelines and recent court rulings. I'll just refer to one of these, a ruling of Justice Meenan there at the start of June this year. The claimant here had received an assessment from the Injuries Board, and the assessment was in the sum of €3,000, whereas if they looked at it in the Book of Quantum, they would have expected somewhere between €18,000 and €34,000. So the issues raised in this legal challenge related to the independence of the judiciary, and separately to claimed breach of constitutional rights, including the right of access to the courts. So I'll just mention a few points raised by or given by Justice Meenan in rejecting the arguments. Firstly, in relation to the independence of the judiciary, he noted that the Judicial Council Act includes a specific provision for independence, and that's Section 93 of that Act. And looking at it another way, the guidelines themselves allow for departure from the specific awards set out within those guidelines, but it is necessary to give written reasons that are rational and cogent and explain the reasoning behind the departure. A further point raised in respect of the breach of constitutional rights and accessing the courts was that quite clearly nobody has a right to a certain sum of damages when they go to court. Rather, they just have a right to have their case heard in accordance with well-established legal principles. And just one point then in relation to the size of the claimant's award in this particular case, that the Guidelines Committee in formulating these guidelines were not mandated to reduce the award in the case of somebody having lower severity injuries any more than they were asked to increase the award for somebody at the other end of the scale with catastrophic injuries. And basically, the change in the awards has arisen solely due to the guidelines, and the guidelines follow the Oireachtas legislation. Finally, these guidelines are subject to review every 3 years, so that means they'll be up for review again by March 2024. Now going on to the injury board reports. So far, we've had 2 reports on the impact of the guidelines. The latest report was published in April of this year. Obviously, given that the guidelines only came into place in April of 2021, the picture is quite limited, and the statistics I give here should be seen in the context of that period of time. For example, the April 2022 report covers the period of 8 months up to the end of 2021. So just before I go into the statistics of the change in size of awards, I just like to note that the number of applications, claim applications in 2019 was €31,000 and fell to €21,000 by 2021. This is probably, one would think, related to the COVID situation. And further to that, in the years 2016 to 2020, the awards, the average award was typically quite consistent, and obviously they were determined in line with the Book of Quantum. So just looking at the impact of the guidelines, you will see here over that 8-month period, the average award was reduced by 42% relative to the awards on average throughout 2020. A further point to note is that 49% of the awards in that 8-month period were below €10,000, whereas that figure was just 12% in 2020. Not surprisingly, given the last 2 points, the claimant acceptance rate dropped, with it going from over 50% of the amounts accepted by claimants prior to the implementation of the guidelines to approximately 40% in the 8-month period referred to here. I might just go on now to court valuations and the discount rate. A lot of what I referred to date deals with cases of a lower severity and a lower level of damages. And I'd now like to speak about other cases where perhaps there'll be catastrophic injury, or where the loss of earnings and care, for example, are the primary aspect. These are the special damages rather than the general damages I referred to earlier. And for these cases, the special damages are often the far dominant component of the whole award. So in terms of determining the future special damages here in the courts in Ireland, we have a rate of 1.5% per annum for most items, aside from 1% per annum for future care costs. The gap here was an attempt at addressing earnings inflation for future care costs. These rates came from the Russell judgment back in 2014, and they are real rates of return. I'm saying here a risk-free rate of return at the time. I suppose perhaps a better way of putting it would be that the rates were determined as the return a risk-averse investor would achieve. And this is compared to the mixed diversified portfolio approach that was in place prior to the Russell judgment being ruled. All of these rates are real rates of return, but it can certainly be said that over the last number of years, they are not quite reflective of the return on index-linked gilts. That was what was deemed appropriate in the Russell judgment, with reference to the UK at the time had index-linked gilts as the basis for their rate of return, and this was deemed what would be a practical scenario for a risk-averse investor. Of note, the rates in the UK have now fallen below 0%, and further to that, whereas previously the rates there were based on index-linked gilts, the rates have now moved to based on a diversified low-risk portfolio, with a little over 40% in England and Wales based on growth stocks and the remainder based on matching assets. It's notable that the rate in Northern Ireland, for example, is 1.5%. Now, going back to the inflation point that I raised earlier regarding care costs. As you've seen, the gap between price and earnings inflation implicit within the Russell judgment was 0.5% per annum. This was set at the time based on earnings for carers back in 2014 at a time when there was low growth, and indeed for some HSE employees, there had been wage cuts in the years following the recession. Of course, the context for inflation at that time is completely different now, but it's still worth noting that all of these rates are real rates of return. As regards periodic payment orders, the situation hasn't really changed since the last current topics paper in 2020. Ideally, these orders would be put in place and they would remove some uncertainty around the issue of life expectancy. But again, the ruling of Justice Murphy back in 2019 is relevant here. Essentially, the PPOs are regarded as being not fit for purpose, and this largely stems from the inflation measure used in the relevant legislation around those PPOs. The indexation measure within the legislation refers to consumer prices, the harmonised index of consumer prices, and therefore this is not seen as appropriate in terms of valuing care costs. Particularly in the case of an individual who has significant care needs, they could be quite severely undercompensated and needs not met throughout their future lifetime if the consumer prices measure were adopted. As it stands, PPOs are not particularly in use in the courts. There is provision for the Minister to change the indexation method, and it will be hoped that if this method is changed and reflects better the earnings inflation for valuing care costs, that PPOs might become more widely adopted. Moving a little away from the personal injuries area, I'll now make some comments on the differential pricing review and the regulations followed on from that. So this review was carried out by the central bank in 2020 and related to the private car and health insurance market. It took on data from policy records and surveys. The central bank published its final report in July of 2021, and there followed a period of public consultation. This has ultimately led to the new regulations due to come in force in the area next month. The headline, I suppose, issue or headline regulation, I suppose, from the differential pricing review is the ban on price walking in the reviewed areas. This essentially means that a subsequent renewal price cannot be set to be higher than the equivalent first renewal price. And I will just have some further points now on the regulations. As part of the regulations, companies will be required to carry out a review on an annual basis of their pricing and policies to ensure that they do not discriminate on the basis of tenure. There is a requirement to ensure that the equivalent first renewals for those with a longer tenure are not systematically higher than the actual renewal price for newer customers. As part of that, it is necessary to have adequate controls on models to ensure that this discrimination does not take place and that appropriate written records are there to cover these scenarios. Specific rules have been allowed in respect of automatic renewals, and this especially means that customers can cancel their automatic renewal at any time with zero charge. Again, there are issues regarding correspondence and specific rules regarding correspondence with customers depending on tenure. And as a general overall point, there is a requirement to ensure that boards have proper oversight and governance and that the appropriate risk management frameworks are in place to cover the pricing policies. The impact on all of this means that customers will have more information. I suppose at this stage, customers are perhaps unaware of these regulations, and the impact of these over time will emerge. The regulations have been broadly welcomed, and there might perhaps be other issues regarding retention rates. This will all emerge in due course. So I think I will leave my section there and I will hand over to Cormac, who will be covering climate change again. So thanks for your time.
Thank you very much, Michael. I'll just set up my screen now. That should all be set up there. Great. So myself and Grania will be presenting our next section on climate change for life insurers and reinsurers. This section in the paper was authored by my colleague in Milliman, Orla Lahan, who unfortunately wasn't able to make today's session. So I'll jump right in and start by giving some context to climate change risks. Governments, regulators, and financial service industries have been looking to better understand the challenges posed by climate change for some time now. Generally, these risks are divided into two broad categories: physical risks and transition risks. So physical risks are associated with the direct impact of climate change, and these can generally be further subdivided into chronic and acute physical risks. So chronic physical risks arise from the longer term shifts in climate change, such as sustained higher temperatures leading to heat waves or droughts, for example. And then the acute physical risks, on the other hand, are event driven and include extreme weather such as hurricanes or flooding. Transition risks then, on the other hand, are more nebulous in nature. These are the risks inherent in changing strategies, policies, or investments as society and industry reduce their reliance on carbon and move to a greener economy as a whole. It's obviously a very broad category, but some examples to sort of help contextualize it and picture it. So the transition to a greener economy could result in large changes in the value of certain assets, for example. or an organization's response or lack thereof to climate change may result in damage to their reputation. So with these in mind, let's take a look at how regulators have been looking at these risks at both a national and then a supranational level. So we've highlighted a number of examples on the slide here. So from an EU perspective, firstly, the European Commission published an amendment to the Solvency II delegated regulations, which introduces sustainability risks and environmental, social and governance, or ESG, considerations into the Solvency II risk management framework. Now, these come into effect from the 2nd of August in 2022, so right around the corner. Now, while the paper goes into a bit more detail here, we have some particular points that we did want to highlight from the amendments. So the identification and assessment of sustainability risks has now been formally added to the tasks of the risk management function through these amendments. This means that sustainability risk must be integrated into a company's risk policies, in particular the investment, underwriting, and reserving policies. Emerging and sustainability risks should also form part of the risk considered in the ORSA process. It's obviously relevant around this time of year as we head into ORSA season. And then finally, the amendments included in changes to the requirements of the annual opinion on the underwriting policy provided by the actuarial function. So accompanying this, EIOPA also issued its opinion on the treatment of climate-related risks in the ORSA to supervisory authorities, and has stated that it will begin to monitor compliance with this opinion from April 2023. Moving on then to a more national perspective, in November 2021, the CBI wrote to all regulated financial services providers, setting out its expectation regarding climate and other ESG issues. Their expectations focused on 5 key areas: governance, risk management, scenario analysis, strategy risk, and disclosures. The CBI is also a member of the Network for Greening the Financial System, or NGFS, which is a voluntary group consisting of 116 central banks and supervisory authorities from across the world. And these publish different papers and documents around sustainability and climate risk. We've also highlighted here some other regulatory developments specific to the UK and France to give a sense of what other countries are looking at currently. I won't go into them in detail here, but I think they help add a flavor to the types of things that people are looking at the moment and what they'll really be focusing on going forward. So with that, I'd like to pass over to Grania to discuss some of the topics regarding what life insurers should be doing in this area of climate risk and some other risks and opportunities in relation to climate change in the industry. Thank you all very much.
Thanks, Cormac. I'm Grania McRory and I am a pricing actuary. I work for Standard Life and have done so for the past 4 years. So I'll just pick up there, following on from Cormac, on what should life insurers be doing currently in relation to climate change. So it's well known that within the industry, we can no longer avoid or postpone addressing the impact of climate-related risks on underwriting, on pricing, and on investment decisions. They need to be integrated into the risk culture and the current processes. So we've split this up into 4 key areas. First and foremost, companies need to identify their risk exposure. And as Cormac already mentioned, this could relate to physical risks or transition risks, such as moving away from carbon-intensive economic activities. Reinsurers need to understand how the drivers of transitions risks will interact with the main types of risks that they face. And there are numerous ways in which various transition risk drivers could impact the types of risks faced by insurers and by reinsurers. Insurers will need to face identifying risks in varying degrees of depending on the reinsurer's balance sheet, target market, business model, and risk policies. The risk identification process should rely on unbiased sources and utilize input from key stakeholders across the business. Once the risks have been identified, the insurer then needs to move on to assess and measure the risks. And this needs to be done in 2 steps. Both the likelihood of the risk happening, followed by the severity of the risk. Companies will need to do this for all the material risks that they'll have identified in the previous step. Assessing climate-related risk exposures is still an emerging area, and as yet there is no best practice set. Once the risks have been assessed and measured, the companies then will need to perform some scenario analysis. To analyse transition risks, different potential pathways to a low carbon economy and the speed at which these pathways could evolve should be examined. Scenarios should reflect external developments such as government action, and Cormac already touched on some of the regulation in the previous slides, technology changes and consumer sentiment, as well as action taken by the insurer itself to transition to a low carbon economy. For life insurers, acute physical risk scenarios may be focused on increased severity or frequency of natural disasters and chronic risks, because these may lead to worsening mortality or morbidity over time. The final stage then is the monitoring and the reporting of risks. Monitoring the risks involves tracking the identified climate-related risk exposures and identifying any new risks when they emerge. Risk reporting involves both internal and external documentation of the risk monitoring. Internal risk reporting helps to ensure that an insurer's activities are aligned with the internal policies and that risk tolerances are not breached. This information helps to ensure the senior management and the board of directors of a company understand the climate risk exposures over time. Therefore, disclosing the impact of climate change in a company's risks reporting is essential to ensure senior management has adequate information to take strategic decisions. Climate-related risks should be incorporated into an insurer's existing risk reporting framework. The current framework will need to be examined to ensure that an identified owner is assigned to the climate-related risks and that the scope of the framework covers the areas of the business and the time horizon impacted by climate-related risks. Insurers will need to be aware of their obligations when it comes to public climate risk disclosures. So that will cover governance, strategy, risk management, metrics, and targets. So we can just move on to our final slide on climate change. And here we'll have a look at some of the other risks related to climate change, as well as where opportunities may arise. So first and foremost, we looked at reputational risk. So with the changing consumer sentiment, reputational risk to companies in relation to climate change is a huge factor. Insurers are coming under increased scrutiny and pressure to mitigate climate-related risks, as well as increased regulatory responses, or to face direct shareholder action and public demonstrations are some of the strongest forces in driving companies to increase their climate-related disclosures. Climate change has been identified as a potential source of reputation risks from changing customer or community perceptions of an organization's contribution or to detract from the transition to a low-carbon economy. Any business with a public profile has the potential to be held accountable for its impact on the environment. There has been the newest hot topic in relating to climate change has been greenwashing. This has emerged throughout the last number of years. Greenwashing is the practice of exaggerating a company or product's green credentials, thereby misleading consumers and hindering meaningful climate change. The CBI has specifically stated that companies must not engage in greenwashing. However, there is no standard accepted definition of what a green or sustainable insurance product does look like, so this is proving challenging for insurance companies across Europe. It's also challenging for regulators to monitor this when there is no definition. There is an example, though, of a recent example whereby Deutsche Bank offices and its asset management subsidiary were raided in Frankfurt just in March 2022. The searches were related to allegations of marketing investment products as more environmentally friendly than they really were. This was prompted by an annual report stating that over half of the group's $900 billion of assets were invested with the ESG criteria. The scandal so far has resulted in the chief executive stepping down. Although this example is related to an investment management company, it is a strong example of what regulators are willing to do to engage with firms to prevent greenwashing. Finally, a number of opportunities also arise in the areas related to climate risk. There's a number of firms who have started to examine the potential opportunities. Insurers are beginning to look at investment risk in legacy investment portfolios. Secondly, insurers have been considering some new areas of product strategy that could help make a positive contribution to climate change. As a global consensus is shifting towards accepting a net zero economy, in the coming decades, there's a need for insurers to set out an approach to manage the investment risks associated with this transition to net zero. One example of this is to invest in greener assets, to give new opportunities to give new investment opportunities and ensure the investment return is related to greener assets. Another option here is potential of offering green products. And this is something we already see in there's likes of green mortgages, green house insurance, and it's also something that's likely to come into the life insurance industry as we move forward. So just to conclude on climate change, while the effects of climate change on our planet are uncertain, it is certain that insurers will be impacted either directly through physical risks or from the transition risks to a low carbon economy, or most likely through both. Given the uncertainty surrounding the impacts to insurers, it's important for firms to assess their exposures to climate change and to account for these within the risk management frameworks. So we can now move on to our final section, which is the diversity and inclusion. I think Simeon's just going to share a few slides. Just a reminder, the Q&A section is open if you want to add any questions to that, because that's what we'll be moving on to next. Okay, so in recent years, the discussion around diversity, inclusion and equality have become much more mainstream, not just here in Ireland, but globally. This has been influenced by many factors. For example, the introduction of guidance and regulation relating to areas such as equal pay and board structures, as well as global awareness being raised through movements through movements such as the Black Lives Matter movement and Me Too movement. Overall, this has led to a greater societal awareness, resulting in many adaptations in our day-to-day lives to work towards diversity, inclusion and equality for groups which may have been considered a minority. So what does this more inclusive and considerate world mean for us as actuaries? Traditional views of the profession have actuaries behind a spreadsheet calculating figures. Surely diversity and inclusion can play a huge role in our day-to-day work. Together with members of the profession representing a variety of different fields, we have explored this idea of diversity, inclusion and equality in the technical day-to-day life of traditional actuaries. Several key themes have arisen through these discussions, which I'll explore now in the following slides. So firstly, we considered assumptions. This is a key area across all actuarial fields, and one in which unconscious and unintended bias may creep in. We explored the idea of varying assumptions. By this, I mean when an insurance company used different assumptions to price the same product, depending on the target market in each case. For example, an insurance company may choose to partner with a financial institution to offer its employees lower cost products as they are deemed lower risk by the insurance company. Not only will the company then benefit from the ease of writing a large number of policies, because these are lower risk, it may also result in higher profitability. Another example is when assumptions are varied based on the distribution channel through which the product is sold. That is, online policies may be offered more favourable terms due to differences in claims experience versus policies that are sold face-to-face. A final example, and one that's particularly common in the likes of car and home insurance, is the varying assumptions based on your postcode or on your air codes. While, of course, these types of pricing decisions do make sense from a commercial perspective, they may result in products we sell being more or less attractive for particular cohorts. As we seek to refine our pricing to the most attractive target market, we may unintentionally disadvantage those from lower socioeconomic groups who arguably are in the greatest need for the protection available from the financial products. We then explored the idea of default assumptions, and it may or may not come as a surprise to many of you that the default assumption most commonly used is that of a white male. For example, if data is incomplete, the policyholder is usually assumed to be male, and if applicable, his spouse is assumed both female and 3 years younger. Not only may this result in incorrect data, it may also lead to skewed insights impacting decisions made around different product lines. In the health space, this is again present, with the majority of clinical research we have built up being based off a default white male life. For example, prostate screening is introduced at an age where the risk increases for white males. However, there's research to show that this risk emerges significantly earlier for both Black and Asian men. Is there an opportunity here to evolve our levels and type of healthcare? Next, we looked at Data access. Issues can arise when we don't have access to the relevant data. For example, the EU law stops employers from asking questions relating to certain characteristics, and these are the protected characteristics. And to add to that, employees and customers may choose to not share this information. How can we ensure we're representative without having the relevant data? A good example here is in terms of a transgender life, when specifically in relation to mortality. They should be considered. However, how can we consider this when we don't have the data available? There also is an issue here too, as only a small percentage of the population would be impacted. Finally, in the idea of assumptions, we had a look at artificial intelligence. As artificial intelligence continues to develop, ethical issues have begun to arise. The algorithms were not designed to discriminate. However, they may accidentally find proxies for characteristics such as gender and unintentionally therefore discriminate. We need to ask ourselves, how much do we know about these black boxes that are used for pricing? We then moved on from assumptions and took a look at the regulation. As has already been touched on, regulation has done great things so far in terms of diversity and inclusion in the industry. For example, the Equal Status Acts, the Equal Employer Acts. However, there are some notable examples where regulation has the potential to result in unintended bias. The capitalisation factors was the first area we looked at in relation to pensions. So this is in the Revenue Pensions Manual. These factors determine how much an individual can accumulate for retirement. So these are actually based off two things. One is gender and one is marital status. And based off the current factors still used today, a married male can accumulate the highest level of income. And sticking with the theme of pensions, auto enrollment, as Tom already touched on, is a great initiative that has been introduced to this industry. However, it doesn't come without its own flaws. The system isn't really built to consider those that are self-employed. And on top of this, the 20,000 per annum salary bracket that Tom mentioned will exclude the lower earners, thus having a socioeconomic bias and disproportionately excluding women who tend to earn less and are more likely to be part-time. Moving on to the general insurance industry, differential pricing, as Michael has already discussed, this review has led to a ban on price walking. So this is most likely to benefit time-poor people, likely those who are already in employment and with higher incomes, whereas the money-poor individuals may feel the negative impact. What will be the outcome here? Are we more likely to see overall premiums increasing? And if so, who will be the net beneficiaries of the new requirement? As well with general insurance, we see a lack of transparency around charges. It's not possible for the policyholders to see what relates to claims, what relates to commission, and there are situations where there's upwards of 50% commission paid, particularly on ancillary add-on products. This doesn't seem fair to the policyholder. However, we have to consider the balance here because more regulation will lead to higher costs. So this always must be considered. A second point worth considering here is it's important to keep trust in the industry. It's often there's adverse media reaction from whenever we try to increase transparency. So if large groups which dismiss all savings and protection products as being bad value for money and not trustworthy as a result of adverse media commentary, this is not in the best interest of those whom the regulation would be designed to protect. Next, we had a look at communications. So the effectiveness of communications methods varies with given cohorts. We've seen a change in demographic here in Ireland, and that's evident through the census results over the last number of years. Do we know enough about the best ways to engage with the different cohorts in understanding or planning for the financial futures? The first thing we took a look at was communication methods. So our current communication methods are likely to be biased to our typical or target customer base, which is likely to be middle class, white, and Irish. Other cohorts may respond better to different interventions or ways of messaging. Are we sure we're considering a broad, diverse potential customer base, in considering how we communicate the benefits of the solutions we can provide. The second point on communications we addressed was ongoing administration. Here we find it's important for a policyholder to have the option to continue to administer the policy the same way they set it up. So if a policy was purchased face-to-face, there should be an option going forward to then administer the policy face-to-face. Moves towards the like of chatbots and only having automatic phone responses. This could disadvantage elderly people, disabled people, or people whose first language is not English. Finally, we looked at marketing. So as most people will be aware, gender neutral pricing is a regulatory requirement. So why do we continue to see gender focused marketing? This is particularly common in the likes of car insurance, where a company may target specifically females, and then they're able to offer lower premiums going forward as their claims base is mostly coming from females. But are men aware that they can also purchase these identical policies? The last section we had to take a look at was market practices. So we took a step back and we looked at the many ways in which we could improve the industry to both be more inclusive for employees and for the customers. So the first thing we looked at here was we can just move to the next slide, sorry. Was the company benefits program. Generally, company benefits programs are centered around traditional family benefits. We've seen in the industry recently, there's been a move by some leading companies to broaden this view, allowing individuals to define who their family is. For example, their friends and their pets. Also, we see that insurance covers have been extended to include an optional pet insurance. The second point we considered was retirement support, and this links back in to the communications that I had just mentioned. So the historic generations of the Irish workforce are more likely to be male and white than future generations. So our retirement support is currently set up to cater for the current retirees. Have we fully considered what additional requirements there might be with the increasingly diverse Irish workforce? It's likely that we'll have a higher proportion of females as well as people from different cultures and nationalities retiring in coming years, and the industry needs to be ready to support this. Linked to this, we have the products that are actually offered here in the Irish market. Again, with the growing diversity of the population, it's important that everybody is representative and that there are products there to cater for different cultures and different nationalities. For example, do we have products available to cater for Muslims who follow strict Islamic finance rules around investments, insurance, and gambling? The final point we considered in the market practices was the current market conditions. At the minute here in Ireland, people are struggling to pay their rent and buy their own homes, never mind paying into a pension. Are we as an industry engaged with the right problems to address the needs of our entire demographic? Finally, and an important point worth noting, the impact of diversity on our own membership and how we approach the types of issues I have just outlined. We as a profession must be as diverse, as inclusive, and as attractive to the broadest range of potential candidates in order to ensure that we will benefit from the associated diversity of thinking and awareness of issues affecting those in marginalised groups. I'd like to thank you all so much for listening to our presentations today, and I hope this will lead to some thought-provoking and insightful conversations going forward. I'll hand you back over to Declan now, and he can pick up the Q&A.
Thanks, Grania. I was just struggling there to find my camera, so apologies for the slight delay. Well, thanks again, everyone, for all of your presentations. It's been a real tour de force to cover so many topics, and there's plenty of material to digest there. So we have a few minutes now. We have about 10 minutes for questions and answers. We already have some questions on the portal, and please feel free to add some more. We're trying to get through as many as we can. So I'll just take them as they arise here, and we'll take it from there. So question number one is back to Jack, the very first presentation. So the question from an anonymous attendee: I note your bank insurer example states that while the long-term impact of the change from IFRS 4 to IFRS 17 on earnings is expected to be neutral, the net income is expected to be lower in the short term. Jack, is it possible to tell us why that might be the case?
Yeah, thanks, Declan. And that's a good question. I was having to think about it there when I saw it come in. The simple one-liner answer is if net income is going to be shorter in the first couple of years, then after that it will have to be slightly higher for some period of time for the overall impact to be neutral. So if we think about why the net income might be lower for the first couple of years post-transition for a bank insurer, their financial statements basis is going to probably resemble something like embedded value. So if we think about their an IFRS 4 basis being on a spectrum of being more or less market consistent, their basis is going to be closer to something like Solvency II embedded value than perhaps most standalone insurers. So how will that work when new business comes onto the balance sheet? Under their current regime, they'll be able to take credit for all of the for all of the expected future profits that will come in over the lifetime of the contract. Now, when we change to IFRS 17, that won't be the case. Instead, the profits will have to emerge over the lifetime of the contract as the contract runs off over a number of years. So that'll lead to a step down from 2023 onwards in the reported income, but that will be offset in future years as net income is higher than it will be under IFRS 4 because we've got that CSM runoff feeding into the net income that's reported.
Great, thanks very much, Jack. So I suppose it relates back to that profit signature that you demonstrated earlier in your presentation. Next question is one for Leslie, back on the health insurance side. When can we expect the high cost claims pool to come into effect?
Thanks. Yeah, so it actually got approved to come into effect from the 1st of April 2022. So that's any contracts which start on or after the 1st of April 2022 can claim for high cost claims. So if a policy, has €60,000 worth of claims, then €10,000 can go towards high cost claim pool credits, 40% of €10,000. So yeah, anything on or after the 1st of April 2022.
Okay, so it's already in force. Thanks.
It's already in force. Yeah.
Yeah, great. A more philosophical question, I think, probably for Tom, not directly related to your presentation, but let's see, can you give it a go? Some developed nations have a state pension scheme where state pensions are linked to the individual salary. I suppose you could argue that might be a more fair system. What are the reasons for the state pension system that we have in Ireland, that is where the pension amounts are pretty much level? And do you foresee that it's likely that Ireland might move away from that system in the future to something more income related?
Well, firstly, it's not likely to move to anything different in the future. I think the intention is to link the state pension to 34% of the average working wage. I think that's the intention in the future. So it won't be moving to a specific individual earnings related amount. I suppose the intention of the state pension is to provide an underpin, and something that will prevent poverty for everyone, rather than to provide an earnings related pension for an individual. So it operates under 3 pillars. The first pillar is poverty prevention, and that's what the state pension is designed to take care of. Second pillar then is to achieve a lifestyle comparable to your pre-retirement, what you were earning. And it's the occupational pension schemes that are expected to look after that bit. So I guess ultimately the state pension is considered a social welfare payment, really, and some people would consider that it is fair because it achieves redistribution of wealth. Higher earners have to contribute more, but people end up with the same level pension. So I guess that's it, really. It's just the design of it is such that it's it's designed to achieve an underpin rather than an earnings rated pension.
Great, thanks very much for that, Tom. A question for Gráinne on the climate change side. What's meant by a green mortgage or a green life insurance policy?
Yeah, so in the green mortgage example, we've seen that some banks offer a mortgage whereby you may have lower interest rates if the house reaches certain standards. So if it's energy rated, if it's got a positive energy rating, in terms, I suppose this is to do with a number of things. It could be if it's a new build, it could have features added in such as solar panels or the heating systems, or it's most likely not to probably be available in some of the older houses, as these are less energy efficient.
Okay, that's interesting because it wouldn't necessarily affect the risk involved in the insurance policy. It's more possibly a marketing tool,
Yeah,
which is aligned with climate change.
Yeah, it's to just get the move to get people thinking more consciously, I suppose, away from to think of the impacts on the climate change with the mortgages. There also then is the investment side of it, that it could be invest in ESGs, but yeah, that is the initial. Is that the properties will be more climate friendly.
Okay, I've seen similar stuff on the non-life side mentioned by EIOPA, where they were promoting this idea of what they called impact underwriting. So you might offer a special deal for say your home insurance for a home that was more sustainable, but again, it's not related to the risk, so it's questionable as to how it might be introduced ultimately. But let's see where it goes. Thanks for that. I have a very short question, probably again for Leslie. It says Sloan Care update. Is there any update you can give us on the status of Sloan Care, Leslie? It might be outside the scope of your paper, but if it's possible.
Yeah, there is. It is covered in a short section in the paper. I guess there's not much progress to date now. I know the Minister for Health did release a report, I think it was in February, kind of giving an update on, a number of, I guess, areas which they wanted to progress and how progress has been made in those areas. But with COVID and everything, it's kind of slowed it down a lot. And there's been a few high profile resignations as well, which has made it kind of difficult to progress there as the main areas. So there's not much of an update, but there is something included in the report on it. But it's basically it hasn't progressed probably as everyone would have thought it would progress since the last current topics paper, but it's still hanging about.
Thanks, Leslie. And I think probably our final question, and this is a bit more of an open question and not directed at anyone in particular, so please jump in if any of you has a burning answer to this. As recent qualifiers, what do you think are the main issues facing the actuarial profession today? Are they the hot topics covered in this paper, or are there other concerns about your careers and the future of the profession that you think the society should be aware of? So I suppose it's a question for newly qualified in general. Is the direction the society is moving in the right way? Are there things we're not thinking about that we should be thinking about? Pretty much an open question, so I'll leave it to you to decide who answers. Anyone can put their hand up if they have anything to offer.
And then
Thanks,
anybody else can jump in. So I'll answer the part there that's asked, are these the hot topics covered in the paper? So are these concerns for basic qualifier? They definitely are. So anything that's going on in the different industries, depending on where you currently are working yourself or maybe going to move into. So these topics are relevant to recent qualifiers just as they are to anybody else, especially in the likes of the climate change that relates to everybody, not just actuaries. Diversity and inclusion, again, this is like a global issue that awareness has been raised. But in terms of other main issues maybe facing the actuarial profession and what these may be, I think that maybe in terms of like data science, how both actuaries and data scientists are going to work together. What is their different skills? What differentiates actuaries and data scientists, and where can these overlap? There's maybe you need to keep the relevance of an actuary, and the importance of doing the exams is maybe graduates could be attracted into the data science route straight after university if this is where companies are maybe pushing for, if there's the salary unit with salaries or whatever way it's working. So I do think that's something that the society definitely needs to consider, how the two can work together, but yet both keep their separate identities.
Great, thanks for that, Anya. I know that's definitely on the agenda of council. Definitely one of the issues we're looking into is the impact of data science on actuaries, and what is it that we can add that's different to what the data scientists do, and how is it we can complement what the data scientists do. Okay, thanks very much for that. I think we're up against it for time, so it's time to bring the Q&A section to an end. So thanks again for all of your questions and all of your presentations. Just a final reminder that the full current topics paper will be available shortly on the Society website, so there's a lot more detail there that you can dig into to follow up on the presentation you've seen today. So at this stage, I'll hand over to Dara Pelly. I'll say goodbye for now. Hand over to Dara Pelly to announce the winners of the Creative Use of Actuarial Skills competition.
Thanks, Declan, and thanks to the recent Qualifiers Committee for sharing the platform with us. Sorry, we head into your Q&A time a little bit there. I'll just bring up the screen. Okay, so we're going to use the next 15 minutes to announce the winner of the SAI competition for the creative use of actuarial skills. So quickly, I'll go through the background of the competition and say a few thank yous, and then we'll have some of the judges involved to give some commentary on the 3 submissions, and we'll announce the winning project, and then we'll play it with the project video. So I hope everyone will hang on with us to see that video out to the end. Bit of background, the competition is run by the Wider Fields Committee. So on this committee, we look at what actuaries do and where they do it, and we look at that kind of as per this quadrant here. So on the y-axis, we have our employer types, our traditional and non-traditional, and then on the x-axis, we have our actuarial roles and the traditional roles that most people be familiar with, and then the not so traditional roles. So the purpose of the Wider Fields Committee is to, help to facilitate, educate, and support actuaries that are looking to move out of the traditional box into some more non-traditional areas. And I suppose that's for all actuaries, be they qualified, part qualified, or undergraduate students. So on that basis, we launched this competition to encourage those undergraduate students to maybe, think more creatively about how the actuarial skill set could be applied and where it could be used. Before jumping into the 3 submissions, I just want to say a few thank yous. So first off, I suppose a bit of further background on the competition, really came out of it's the brainchild of Colin Fitzgerald there. So back at the 2019 SAI convention, he had 5 groups of students present about where they think actuaries could work and could add value outside of those traditional areas. And then on the back of those 5 presentations, he came to the Wider Fields Committee and asked, would we look at rolling that out across the island of Ireland? So the committee was chaired at the time by Garrett McQuillan, and he duly accepted that. So this is the 2nd iteration of that competition. This year, the projects come from students in UCC and Queen's University Belfast. So I'd like to thank the university staff there for helping to promote and encourage the students to get involved. Also, look, there's a lot of logistics behind doing this, so a big thank you to Katrin and Simeon and Yvonne and the SAI officers there for helping us run the competition. And additionally, I suppose there's a bit of a community effort here. There's lots of volunteers involved in supporting this competition. So from the Wider Fields Committee, Ger Bradley, Claire Lanigan, Shane O'Byrne, Brian Murphy, and myself were all members that picked up and moved the competition along. Then our judges, Ramona Dolan, Tom Barry, Breach Quigley, and John Landers. And our mentors, Rada Mahoney, Sinead Clark, John Castellan, Kieran O'Sullivan, Mike Fitzgerald, and Ashton Kelly. Just a huge thank you to the judges and mentors there for giving your time. Obviously to judge the competition, and the mentors for helping the students to cultivate their ideas and bring it together and bring it to life. So thank you all for your help there. At this stage, I'll hand it over to Ramona to introduce the first project.
Thanks, Dara. Good afternoon, all, or good evening at this stage. So as Dara mentioned, my name is Ramona Dolan. I'm Head of Professional Affairs with the Society, but I also had the pleasure of being one of the judges for this year's competition. So I'm just going to give a quick overview of one of the submissions, and this is Aulige. And this was a submission by 5 students for studying risk and actuarial studies in UCC. So those students were Xixi Bian, Xinran Wang, Qinwen Tan, Xiaoyu Liu, Shenteng Yang. So apologies, I'm sure my pronunciation wasn't great there, but I will say that we we did make an effort to get it right, because we are very much aware of the amount of effort that goes into these submissions, and we really do appreciate it. So the least we can do is try and get the names right, even if we don't succeed. So just in relation to the project itself, so this group looked at analyzing the impact of COVID-19 on different sectors of the Shanghai stock market. So their aim was basically to see which stocks performed well. So maybe this information could be used again by investors in the future should similar events occur, which we hope it doesn't. But in terms of the methodology they used the event study methodology to determine which of those sectors performed abnormally well or abnormally poorly relative to the index itself. And within this, they used principal component analysis to determine the return on the individual sectors. So it was clear from the project and from what we received that an extensive amount of data was gathered and it was well handled. In terms of the results, it showed probably what we might have expected, in the sense that computer application, beverages, and media products sectors did well. But clearly it's a benefit to have the detailed analysis behind it to support these views or expected results. So in terms of our overall opinion, we thought it was a very thorough analysis of a very topical product, and we would like to thank the team for all their efforts.
Thanks, Ramona. Then the next competition, John Landers, might you want to say a few words on this one?
Yeah, good evening, everyone. So I just want to say a few words on the STEMism team and their entry. So STEMism is made up of 3 third-year students from UCC, and Kate Cochran, Emily Walsh, and Joey Wetz. They took on a very topical project, I suppose. They were inspired by the gender imbalance on their own college course. So they set out to examine the leaky pipeline where insufficient women are reaching professional levels in the STEM sectors. They linked in with the Society's own gender pipeline working group, who have been exploring the decline in female entrance to the actuarial profession over the last 10 years. And we were impressed with the team's kind of proactive engagement in this regard. They displayed a clear application of their actuarial skills through a very comprehensive data analysis exercise, looking at results of the junior and the leaving certificate exams, as well as university STEM subjects for a long period of time. They used good data sources and they credited the data sources they used, and where they found any limitations in the data, these were clearly laid out. Now, we loved, as the judging panel, we loved their presentation. The results of their analysis were presented well, both in the video and in the written report. And we particularly liked the easy to use and easy to understand graphs and data model that they had. But probably of most significance was the team's finding that the introduction of project maths in the Leaving Cert syllabus over 10 years ago may have inadvertently led to a consequent gender imbalance in the Leaving Cert maths and indeed beyond. We believe that this was a very important finding, and it helps support previous work done by the Society in this regard. And it certainly merits further analysis. And we really welcomed the team's offer of making their data and their analysis tools available to the Society's Gender Pipeline Working Group, and indeed any other stakeholders investigating this topic. So a big thanks to STEMism and bringing, I suppose, their creative use of actuarial skills to tackle a real world topical issue and present such an important finding in a clear and professional manner. So well done, and thanks to the team.
Thanks, John. And then the final team, Breach, might give a few words on Enthusiact.
Yeah, thank you very much. I'm delighted to be involved in the competition again this year. And it's great to see the actuarial skill set being brought to bear. Enthusiact was a team of 2, Niamh Brown and John McGuinness. And I think it may become a new word for the Oxford English Dictionary to incorporate actuarial and enthusiasm in the one word. So I'll be using it again myself. But I guess, you know, John and Niamh brought the actuarial skills to something that is very dear to their own hearts, which is the issue of animal welfare and pet owners. And I guess also very topical post-COVID, where, you know, we've all heard the reports about the numbers of animals being, you know, pets being taken in by families, and then maybe not finding that it's the life that they had really intended to have. So it was great to see it's great to see something personal being looked at from that point of view, and you get clearly very enthusiastic actuarial students coming in to look at it from that point of view. So the premise of their project was that with better data and analysis, animal shelters might be able to achieve better adoption outcomes for rescue animals. And by doing that, then to increase the vacancies within the shelters and ultimately reduce the numbers that have to be put down. We were delighted to see that the team had engaged with quite a number of shelters and you know, in trying to understand what data is out there, but I guess disappointing to them and everyone who loves animals is that there is no data really kept by any shelters, even big ones across across Ireland and the UK. But it was great to see that the team didn't let that stop them. They went a lot further afield, actually, to Malaysia and Kentucky in the US, and got some data that they could use to develop a model to prove out the theory or their premise that they were exploring as part of their project. So they went and they built a model of that could be used by shelters to understand better, you know, the factors that influence a particular pet's likelihood of adoption, and then that they could use that within the shelters to organize themselves better, you know, to get more animals adopted that way. So it was really nicely done, nice presentation on it, and the clear passion that they have for their animals came across very, very clearly in both of those. So well done to John and Niamh on that.
Thanks, Breach. So we'll bring it over to the announcement at this stage. Before I do announce the winner, just reiterate the judges' comments. Look, they were all fantastic submissions. I think the future of the profession is bright. Some, you know, really good students on the way up there. And look, whilst there's only one winner of the top prize, you know, I hope all of the students got value out of their projects and working with their mentors and starting to, you know, foster a network and a link with you know, currently practicing actuaries. You know, and everyone should be really proud of their submissions, and it also encourage them to get future value out of their project as well, and make sure they have a link to their project on their CVs, and hopefully it'll help them stand out from the crowd as they go into the world of work. So without further ado, announce the winner is the STEMinism project with the women in maths. So that's Emily Walsh, Kate Corcoran, and Joey Wetz. I don't know, Simeon, if we're able to unmute Kate Corcoran potentially on the.
I've just unmuted Kate there. So is Kate there?
Hi, are you able to hear me?
Yes, we can hear you.
Hi everyone. We are so grateful and honoured to have been selected. I want to give a massive thank you to our mentors Sinead and Mairead, who provided us with such insightful feedback and support. Joey, Emily and I really enjoyed doing this project, and the topic of women in STEM is one that's so important to us. We have plans to continue on with the research, and we are so excited to see where it takes us. Thank you so much.
Brilliant. Well done, Kate. Glad to see that'll push on. It's just the start. So look, at this stage, we're going to close out on the winning video here. So hopefully people will join to the end. But at the end of the video, then the line will cut and we'll close the meeting. So again, well done to all the students, and thanks to everybody that was involved in helping out with this competition. And again, thanks to the recent Qualifiers Committee for sharing their platform this evening.
STEMinism, an investigation into women in STEM. We are a group of third-year students currently studying financial maths and actuarial sciences in UCC. My name's Kate.
My name's Emily.
And my name is Joey.
We all did higher level maths, physics and applied maths for the Leaving Cert.
Actuaries have a highly specialised skill set. This includes analytical problem solving, computer skills and data analysis skills. As future actuaries, we have used these skills to prepare an investigation into women in STEM, and in particular, women in maths.
It is widely known that there is a lack of women in STEM sectors. We see this lack of gender parity in our own college course. This inspired us to investigate the leaky pipeline, a metaphor for the way that women aren't reaching professional levels in STEM sectors. We met with representatives from the SAI Gender Pipeline Working Group to discuss our research and analysis.
The SAI Gender Pipeline Working Group is exploring the decline in female entrance to the actuarial profession in Ireland over the last 10 years and the possible explanations for this. Ultimately, our goal was to help them with this work by collecting and analysing large amounts of data on female grades and uptake of STEM subjects, an objective that was personally important and meaningful to us, but also highly meaningful in today's world.
We began research by compiling data. Using the State Examinations Commission Statistics Archives and the Higher Education Authority Archives, we gathered data on Junior Cert, Leaving Cert and third level education. We used this data to analyse grades by gender, subject, level and year. We compiled this into an Excel worksheet and made a drop-down list so we could easily access and compare this information.
We collected data for grades awarded in Junior Cert and Leaving Cert from 2007 to 2021. At Junior Cert level, we looked at maths, science, metalwork, technology and technical graphics. At Leaving Cert level, we looked at maths, applied maths, physics and chemistry, agricultural science, biology, engineering and technology. We then looked at 21 universities across Ireland from graduating year 2013 to 2018 and compiled the data from STEM subjects, separating them by grade, gender and field of study. We created a drop-down list to make our analysis easier, which can be seen here. We also calculated the amount of A's or H1s and B's or H2s achieved by males and females at Junior Cert and Leaving Cert level. It is important to note that females consistently outperform males.
Analysis and findings. Through this work, we were able to see that many trends arose.
The graph shows the percentage of females and males that were awarded an A or B grade at Junior Cert level. Males and females are performing relatively equally.
From 2007 to 2011, this also appears true at Leaving Cert level. In 2012, males performed significantly better than females and continued to do so until the introduction of predicted grades in 2020. Upon further investigation into the Leaving Cert class of 2012, we discovered that this was the first year that Project Maths was fully implemented. Each subsequent year has also followed the Project Maths syllabus, and it remains in practice today.
It is important to note that in other STEM subjects such as chemistry, biology, engineering and physics, males and females performed relatively equally until the introduction of predicted grades in 2020, where females outperformed males. This is highly significant as it begs the question, if females are able to compete in other STEM subjects, how do we explain the significant difference between males and females in maths? Project Maths is a name given to the mathematics syllabus currently in use in Irish secondary schools. It was introduced in 2012 to encourage more students to sit the higher level exam. The advantages include increase in problem solving skills, understanding real life applications of maths, and an extra 25 points for passing the higher level exam. Disadvantages include wordier questions and removal of topics that are important for those who wish to continue with maths at third level.
When we look at mathematics and statistics courses at university level, we can analyse both the uptake rates as well as the grades achieved. From the first graph, we can see that the percentage of females in maths and statistics courses have been consistently well below half in recent years. The first students to sit the Project Maths Leaving Cert graduated from university in 2016. It is interesting to note that female enrolment fell significantly this year, illustrating the correlation between female performance in Leaving Cert Maths and female enrolment in the subject at third level. We can see from the second graph that the percentage of females graduating with a first-class honours degree is competitive with the corresponding statistics for males. For example, in 2017, females accounted for only 28% of all mathematics students, but achieved 34% of all 1-1 degrees.
By following students from junior cert through to third level, we were able to analyse trends in both female uptake and grades in a given subject. This would not have been possible without creative use of the actuarial skills we've developed to organise and analyse the data we collected. From our analysis, we can see that since 2012, females are consistently outperformed by their male counterparts by a larger gap than in previous years. This discrepancy did not appear in any other STEM subject, and so we believe further work should be carried out in relation to the impact of project maths on female students. Following on from the drop in grades, we see a decline in enrolment in maths and statistics at university level, which inevitably leads to a drop in the number of females entering the actuarial workforce.
One of our main objectives was to assist the SAI Gender Pipeline Working Group and provide them with useful tools and analysis to assist in their work on the so-called leaky pipeline. We also wish to make this information available to any other stakeholders interested in exploring the gender differences in STEM subject at Leaving Cert and college level. While we do not believe, as a concept, that project maths is inherently bad, our analysis has shown that the current syllabus results in gender imbalance, which should be addressed either through changes to the syllabus or to the implementation of project maths. Even though our focus was primarily on maths, and by extension, project maths, the Excel database and worksheet we have created can be used to perform similar analysis on all STEM subjects.
Thank you for listening. Kate, Joey and I all enjoyed putting this investigation together, and we hope you enjoyed listening.
Well done again to STEMism and to the other teams. And with that, I think we'll close out the session. Thank you all.